Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, March 17th, 2026, and we have a lot to cover today, Lizzie. What are the main themes you're seeing in today's news?
Thanks, Robert.
Well, the dominant story continues to be the oil market shock from the escalating tensions between Iran and the Gulf states. We're seeing crude prices surge past $100 per barrel after Iran targeted energy infrastructure in the UAE, including setting a gas field ablaze and striking a tanker near the Strait of Hormuz. This is creating ripples across global markets with the Dow, S&P 50 and Nasdaq futures all wavering as investors try to assess the potential economic fallout. What's particularly notable is how different asset classes are responding. Fund managers increased their cash reserves at the outset of this conflict by the most since COVID emerged, which tells you something about the level of concern out there. Meanwhile, we're seeing UK petrol prices surge to their highest level in 18 months. The financial cost for Gulf energy producers is mounting, and there's a real question about whether this oil shock is just a temporary blip or signals a new normal for energy markets. On the corporate front, we're getting some positive signals from the airline sector that are somewhat counterintuitive given the oil price spike. Delta and American Airlines both raised their revenue guidance, citing strong growth in travel demand, which suggests consumer appetite for travel remains resilient despite higher fuel costs. And in geopolitical developments, Israel reported that Iran's security chief, Ali Larijani, was killed in a strike, which could further escalate tensions in the region.
That's a significant development on multiple fronts. How are you reading the market's interpretation of these events, particularly this divergence between the oil shock and continued consumer demand?
It's a fascinating dynamic, Robert. Markets seem to be pricing in two competing narratives right now. On one hand, you have the immediate energy shock that's creating uncertainty and driving investors towards safety, hence the massive move into cash positions. But on the other hand, the airline guidance suggests that consumers are still spending on discretionary items like travel, which indicates the underlying economy may be more resilient than the headline volatility suggests. From a trading perspective, this creates both risks and opportunities. The energy sector is obviously benefiting from higher oil prices, but you need to be selective because not all energy stocks rally during geopolitical conflicts. There's an old Wall Street saying about buying the peace, not the war, and that's relevant here. Defense contractor stocks, interestingly, aren't rallying as much as you might expect, according to the Wall Street Journal, which suggests the market may be skeptical about sustained conflict. For traders, the key is watching whether Bitcoin's recent resilience holds up. We've seen crypto actually outperform traditional safe havens during this turmoil, with Bitcoin holding near 73,800 despite the broader market stress. That decoupling is significant and suggests institutional demand is returning to digital assets, even as traditional markets show weakness. The other area to watch is Europe's green power infrastructure, which Bloomberg notes is helping soften the energy price shock there compared to previous oil crises. That's a structural shift that could create longer-term opportunities in renewable energy stocks.
That selectivity is going to be key for navigating these conditions. Steve, let's get into the economic numbers. What's the picture looking like this week?
Thanks, Robert. Earlier this week, we got industrial production data on Monday, March 16th, which showed actual growth of 1.4% compared to the previous reading of 2.33%. That deceleration in manufacturing activity is worth noting as it suggests some cooling in the industrial sector. Now looking ahead, we have several critical releases coming tomorrow and later this week that could really move markets. Wednesday, March 18th, we're getting three important indicators. First is the federal funds rate decision, where the forecast is 3.75%, unchanged from the previous rate of 3.75%. The market will be watching closely for any signals in the Fed's statement about future policy direction, especially given the recent oil price surge and its potential inflationary impact. Also tomorrow, we'll see the producer price index with a forecast of 0.3% compared to the previous reading of 0.5%. That would represent some moderation in wholesale inflation if it comes in as expected. Factory orders are also scheduled for tomorrow with a forecast of 0.1% growth compared to the previous reading of 0.7%, indicating a potential slowdown in manufacturing demand. Then on Thursday, March 19th, we get initial jobless claims with a forecast of 215K compared to the previous week's reading of 213K. That would be a slight uptick in claims, but still consistent with a relatively healthy labor market. The big focus this week is definitely going to be on that Fed decision tomorrow and how policymakers are interpreting the recent energy price shock and its implications for inflation and growth.
Those are important data points, especially with the Fed decision coming at such a volatile moment. Lizzie, let's shift to our stock of the day. We're looking at Strategy Inc., ticker MSTR, which has really transformed itself over the past few years. What's your take on where this company stands right now?
Strategy is one of the most polarizing names in the market right now. Robert, this company has essentially transformed from a traditional enterprise software business into what Bernstein is calling a Bitcoin central bank of last resort. They're the largest corporate holder of Bitcoin globally, and their entire investment thesis is now tied to cryptocurrency rather than their legacy analytics software. Looking at the numbers, the stock is currently trading at $147.52, which is down 68% from its 52-week high of $457 year to date. It's down about 6%, but over the past year it's been absolutely crushed, down nearly 50%. Now here's where it gets interesting. The company just executed its largest single-day Bitcoin purchase using proceeds from a new preferred equity issuance. They're calling STRC over a 2-week period. They bought $2.845 billion worth of Bitcoin, including 22,337 BTC, at an average price of $70,194 per coin. Analysts have a consensus price target of $378.71, which represents a 157% upside from current levels, and they're rating it a strong buy. But here's what investors need to understand about the valuation. The stock is trading at a price-to-book ratio of just 1.04, essentially at book value, and the forward PE is only 2.14 if those earnings materialize. On the surface, that looks cheap. However, there's no current PE ratio because the company may not be profitable on traditional metrics, and we're seeing rising short interest, which indicates growing market skepticism.
That valuation disconnect is striking. What's driving the skepticism, and how should investors think about the risk-reward here?
The skepticism comes down to several factors. Robert, first, the continuous equity issuances are diluting common shareholders. This new preferred equity structure is particularly concerning because it creates a priority claim ahead of common stock, meaning common shareholders are now subordinated in the capital structure. You're essentially buying a leveraged Bitcoin fund with additional corporate structure risks layered on top. The company carries significant debt obligations that were used to purchase Bitcoin, so in a severe crypto downturn, there could be real balance sheet stress. Looking at the opportunities, if Bitcoin recovers and sustains a rally, Strategy provides amplified exposure because of their leverage and capital markets access. The institutional adoption thesis is gaining traction, with Bitcoin ETFs seeing a 6-day inflow streak and the asset proving resilient during the current geopolitical tensions. Strategy's unique positioning as the largest corporate holder could command a strategic premium, but the risks are substantial. Bitcoin volatility directly impacts the stock, and we've seen that play out with the 68% decline from peak levels. The rising short interest suggests sophisticated investors are betting against this model. There's also regulatory risk around cryptocurrency that could impact their holdings or ability to raise capital. My view is this is only appropriate for investors with very high risk tolerance who have strong conviction in Bitcoin's long-term appreciation and understand they're not buying a software company. They're buying a complex leverage bet on crypto. The 157% upside to analyst targets is enticing, but you could also see significant downside if Bitcoin weakens. I'd say if you believe Bitcoin is going significantly higher and you want leveraged exposure, Strategy offers that, but size your position accordingly because this is a binary outcome type of investment. You're either going to do very well or potentially lose a substantial portion of your investment.
That's a clear framework for thinking about the risk profile. Let's move to crypto more broadly. Lizzie, what are you seeing in terms of trends for Bitcoin, Ethereum, and Solana heading into next week?
The crypto market is showing some really interesting dynamics right now. Robert Bitcoin is exhibiting what I'd call cautiously bullish momentum. We're seeing BTC testing the $75,000 level after a strong rally that's been largely driven by derivatives and short liquidations. The positive news is that Bitcoin ETFs just posted their longest inflow streak since October, indicating institutional demand is genuinely returning despite the broader market turmoil. What's particularly notable is Bitcoin's decoupling from traditional equities during this Iran conflict. While stock markets have been volatile, Bitcoin has actually outperformed both gold and equities, which validates the diversification thesis that many institutions are building positions around. The technical picture shows an 8-day winning streak, though we need to remember that similar streaks occurred during the 2022 bear market, so it's not a guarantee of continued upside. Traders are watching about $2 billion in liquidation risk as the market hovers near key technical levels. The sentiment is mixed to bullish for the near term, with potential to reclaim 75,000, but we could see consolidation since the market remains somewhat overbought after the recent pullback. On Ethereum, the picture is more clearly bullish. ETH surged 10% recently, leading the broader crypto rebound. What's driving this is increased institutional accumulation, particularly by Bitmine, which just boosted its Ethereum treasury to nearly 4.6 million ETH. That's significant buying pressure. Ethereum ETFs are also seeing strong demand, and institutional investors reportedly maintained diamond hands during the recent 50% plunge in crypto markets, which shows conviction. Some on-chain indicators are pointing to $2,800 as the next price target for Ethereum. The risks here are similar to Bitcoin, mainly around short-term volatility and potential profit-taking, but the institutional support looks solid for Solana. We're seeing potential for a breakout above $100 based on an ascending triangle technical pattern. Solana tends to correlate with overall crypto market sentiment. So if Bitcoin and Ethereum continue their strength, Solana should follow. The key factors to watch across all three are continued institutional inflows, particularly through ETFs, the Fed's decision tomorrow and how that impacts risk appetite, and whether Bitcoin's resilience during geopolitical stress continues. From a positioning standpoint, the institutional versus retail dynamic is shifting. Institutions are clearly accumulating Bitcoin and Ethereum through ETFs and corporate treasuries, which is tightening supply. Retail participation seems more cautious, which actually could be healthy for a sustained rally, since it means we're not in euphoric territory yet.
Lizzie, Steve, thank you both for those insights. To our listeners, we've covered a lot of ground today, from the oil market shock and its ripple effects to the Fed decision coming tomorrow, Strategy's unique Bitcoin play, and the evolving crypto landscape. As always, remember, do your own research and consult with financial advisors before making investment decisions. The markets are particularly volatile right now with geopolitical tensions, so risk management is more important than ever. If you found today's discussion valuable, please subscribe to The Morning Bell wherever you get your podcasts. We're here every morning to help you navigate the markets. Until tomorrow, I'm Robert, and this has been The Morning Bell.